Hi and welcome to the Core Report. I'm joined by Sachin Gupta, Chief Rating Officer and Executive Director at Carriage Ratings. Sachin, thank you so much for joining me. So we're going to talk about three things. First is to understand how India Inc. is doing right now. What's the profile and what's the cockpit view of India Inc. as you see today?
Right.
I think the second thing is to try and understand what their credit quality has been and how it's, or rather where it's going.
Right.
And third is to understand in this dynamic environment, which includes tariffs, how do you see companies being equipped and how are you as a rating agency tracking those changes?
Sure.
And is it even possible?
Yeah.
So let's talk about the profile first.
Yeah.
And as you look back 24, 25,
Right.
what are you seeing or what can you see?
Yeah. So if you see the credit quality of corporate India has been on an upswing for at least last 3-4 years. One of the ratios that we often look at is something called a credit ratio, which is number of upgrades to number of downgrades. So that ratio for the nearest 6-month period was more than 2. It was 2.35. So at an overall portfolio level, we upgraded 2.35 companies for every downgrade that we did. And this ratio, ever since pandemic, obviously during pandemic, the ratio went down, but post-pandemic, it's been consistently in the range of 1.5 to 2.5 or so. So that very basically reflects that, the credit profile is improving. So that is kind of an indicative thing. But there are actually a few clear structural things which have happened in the corporate India, which has led to this improvement. And one of the biggest one I would say is the IBC, because of which the cost of default for a corporate has become very high. So that, the corporates try their best, especially the promoters, to not let the company go into default, because once the default happens, their access to debt funding or even equity funding is extremely restricted. So they try their best, which is very different than how it used to be earlier, when the corporates would typically, try and see if they can get some haircut, some leeway from the banks, and then they will, try and delay payments, etc. So now the credit culture in the country is significantly better. So that's what we've seen. I mean, if I were to share one more matrix, typically for an investment grade, I mean, there are about 12,000 investment grade companies in India as we speak. At least I'm talking about the large 4 rating agencies, what they rate, right? 12,000 companies. Roughly till about 4-5 years back, every year there would be more than 100 companies which would default out of these. Right, so 12,100
and loans from banks.
Loans mostly from banks. Some of them could be bonds as well. Some of them could be high profile, like your ILFS and Diwan and all that. But I'm just saying at an aggregate level, about 120 companies would default, right, on an overall portfolio of about 12,000 companies, which is roughly about 1%. But now, if you see the last 3-4 years, the period I'm talking about, that number is, I mean, either in high single digits or low double digits. So basically about 8, 12, 15, that kind of a number across, again, 4 rating agencies. So that the default numbers is actually now almost 1/10 in terms of number of companies. And again, the defaults which are happening now are smallish, lowly rated entities. So the investment grade starts from BBB minus and above, right? So BBB minus, BBB, AA, AA, AAA, and so on. So now we are having defaults mostly from BBB category, which is the right thing, which means the weaker ones in the overall portfolio, they are kind of getting hit. So the point I'm trying to make is that at an overall level, the credit quality of Indian corporates is clearly strong, reflected by, as I said, lower number of defaults, higher credit ratio. Also, the other key parameter how we look at it is the leverage. So, right, so typical either debt to EBITDA or debt to equity. If we look at this data across the last 10 years, there has been a significant improvement. So, debt to EBITDA for the top 1,000 companies was, ballpark around 3. Now it is about 1.5, 1.6. So we can see material improvement. So the corporates are kind of having more, I would say, prudent financial norms, and therefore, yeah.
Yeah. So when you said that a few years ago, it was the default rate was 1%, but correct
now I'm just saying this.
Yeah, roughly
1%. Yeah.
But now it's anywhere between 8 and 12.
0.1% or so.
Today it's 0.1%.
Yeah. So I'm saying about 12,000 companies, and the total defaults would be about, say, 10, 12 or so.
You're saying the default rate has dropped quite dramatically within this period.
Yes.
Okay.
Yes.
So now, even to go back to your earlier question about health,
right,
and you said the upgrades versus downgrades.
Right.
So what's the, let's say, is there a predominance of companies or sectors which is tilting the view either ways?
So broadly, if we were to kind of split our overall corporate Inc. into, say, manufacturing, which includes, say, manufacturing and services, let's keep them together. Then BFSI, which is a bank and NBFCs, and infra, right? These are the 3 things. So the best and the most consistent is infra. And that has actually been the biggest delta, because you may recall, 8-10 years back, infra was kind of tough. Banks had the highest amount of NPAs in infra. But now, because of multiple reasons, many of them because of the government, say NHAI or SECI, these are large institutions who've been playing active role in being the, minimizing the risk for the developer. Also, the banks have been more prudent, etc. So infra has been kind of consistently having high credit ratio, right? Their ratio would be 3, 4, that kind of a thing. Another thing, the reason for that is that typically when we rate a project, it will be at a construction phase, so the rating is low, say a triple B or something. As the project gets completed, it could go up. For some of these NHAI HAM projects, it could actually go up to triple A, because once the project is complete, the counterparty is only NHAI, and if the proper DESRA and other those mechanisms are there, then the rating could match the NHAI's rating, which is triple A. So infra is good, and infra is which is growing also. So the incremental debt, if you see, is largely coming in infra, both on roads and then other on renewable energy. These are the two big sectors for credit growth in the country. So that is on infra. Second, I would say, is the manufacturing and services. There it's a mixed bag. There, if you see the companies which are more domestic facing, especially in the last year or two, and say healthcare or hospitality, even say pharma, those industries are doing well. But say some of the sectors which are more exposed to competition, in last year especially, we've seen a lot of dumping which is happening, say from China, because of their own growth not happening. So in that, so chemicals, so that is something which we have seen an impact on the credit ratings going down. Also steel, small steel producers, because the prices which were very high have now kind of come down in the last year or so. So that is when some of the mid-size and the smaller players, they have been facing some of the heat there. So largely export exposed sectors is where we have seen some bit of pressure, and which is what we are in fact expecting going forward as well, because this whole issue of dumping, etc., because of tariffs may actually be even worse.
Right. So you said infra, manufacturing services.
The BFSI. Now BFSI, again, if you see broadly, we classify into, say, banks and NBFCs. Banks underwent their whole catharsis and a lot of equity infusion. Post that, when after the government infused equity in all these PSU banks, their performance has been good. In fact, their NPA levels are at their lowest level ever, right? Less than 1% or so. So that is again a strong point, which allows them to grow. And while they've not been growing in terms of credit growth, but that's again at least the balance sheets are strong. Within NBFCs, there are pockets where we are seeing stress, especially the people lending to the bottom of the pyramid kind of a thing. So if you see MFIs, there's been a clear deterioration. We are still not sure whether it's out of the woods or not. Because of aggressive lending, we saw there was, that's typically bottom of the pyramid. So those borrowers took too much of debt, and now they don't really have money to pay really. So that is what has led to MFI sector being this thing. Other segment is unsecured loans. Within that, business loans and personal, both we are seeing stress. But otherwise, if you see, say, home loans and other secured credit, that's doing well. So at an aggregate level, NBFCs which are only focused on these segments like microfinance, they have faced downgrades. But if it's a large diversified NBFC with exposure across the segments, then that's been okay.
Right. So if I were to take these three now, that's infra, manufacturing services, and BFSI, assuming this covers how much?
Pretty much. That's everything. Everything would get classified within either of these three.
And that's almost 12,000 companies.
Across the 4 rating agencies, yeah. CARE would have roughly about 3,200 or so.
Got it. So, and if I were to extend that further and say, to what extent does it represent the health of the economy, what would I say?
No, so it is, so there are 2-3 aspects. I have to concede that as a rating agency, we are only looking at one aspect of it's only the credit risk. Right now, one of the reasons which I didn't mention is that the reason why the leverage has been low is helping the credit quality. But the flip side of that is that the companies are not doing as much of capex as may be required. If I were to look at an overall economic growth or the GDP growth and all that, people have been playing a little safe in that sense. So from a pure credit risk, it's all good. But if I were to say that from an overall economic growth, there could be further growth potential if these companies were to invest more, considering that their balance sheets are reasonably strong right now. But still, I think they are kind of not so sure, because the capacity utilization, etc., are still hovering between 75 to 80%. So, and especially now with this the whole tariff thing, I think the private capex will actually be even more uncertain for people to really put more capital.
Right. And this is a sort of health plus status question. When you talk about, let's say, NBFCs facing strain, or those who are lending to microfinancial institutions or unsecured loans like credit cards and personal loans and so on, where everyone knows there's a problem.
Correct.
What's the time lag between your either discovering or bringing that data up and then saying, okay, now we need to revisit this on a normal basis?
Yeah. So
conceptual question.
Yes. So we, for all the listed companies, right, where the numbers are available on a quarterly basis, we do a quarterly review. So say, for example, for MFI, every quarter we will look at the overall portfolio and very closely look at the numbers, where the stress is building or it is waning. So typically on, I would say, high risk, highly rated portfolio, we will look at on a quarterly basis. But there could be another sector, say, which is also facing stress, is say cut and polish diamonds. Diamonds, because of these lab grown diamonds and other stress, the prices have been a little weak. Now there we may not get information because most of them are unlisted players. So there we face a bit of challenge that, and especially if the numbers are not good, corporate companies are not so keen to share it, promptly. So there could be a bit more lag. But
again, there would be companies who are, in any case, borrowing funds for which they need rating, for which they come to you.
Correct.
In this space.
Absolutely. So if that happens, obviously we kind of get to know and we assign the right rating. But I'm just saying that, just to carry forward the example of diamond sector. Yeah, that sector is not really looking at more leverage. They are actually shrinking in terms of their size of operations. So they may not be really looking at more debt. So there we may not get to know on a quarter to quarter basis. But as per our regulated practice, at least once a year, I rate all my companies. So roughly I have about 5,000 companies, including investment grade and non-investment grade. I have to rate them at least once a year. And for the ones which are more vulnerable credits, we will do at least once a quarter.
Right. So if you were to look at, let's say, previous cycles or previous years and compare it with what you're seeing today, which is like a fairly healthy portfolio.
Correct.
Functioning at lower capacity utilization, particularly in areas like manufacturing.
Right.
Economy is steady but not growing as the way we would like it to.
Right.
Where do you think we are poised, going by the past?
From a credit risk perspective?
From a credit risk, and so the credit risk is perhaps very visible to you. But in terms of, if you were to say, okay, now this is the mix.
Right.
Do you think this? Are we at a stage where companies are looking like they could expand?
Right.
Given all the other factors?
Right.
Or does it look like they're going to hunker down for longer?
I think that's a question that I also, a lot of times think. And you're right, because as we discussed, the leverage is low, the capacity utilization not so high. So they are actually in some ways at crossroads. The corporates, whether they should expand or they should just continue where they are. And the domestic demand, that's really the base of it. Now, domestic demand also, what we have seen is not really going through the roof, right? It's going at a steady pace. And then
we've just seen levers and nesting for example.
Yeah.
These are all
exactly. So that way again, so levers example is something that we will look very closely, because that is really the, in some ways, the base consumption, the staple consumption, etc. So nothing great in top line or bottom line. So I think while the government has taken steps, right? So the growth can happen through investments, right? That is what we're saying. You invest, then you export, and then you have the growth, because domestic demand is where it is. Now there, I think that while the government has taken a lot of steps on PLI, Atmanirbhar Bharat, and all these things, but there are pockets where the investments have happened. Say solar backward integration, we're seeing a lot of action happening there. Electronics, some of the action is happening there, Apple moving to India and all that, but it's not broad-based. So if you see broad-based investment, private investment is not yet happening. People are still a little, I would say, tentative, nervous before really going out. And the government keeps saying, let out the animal spirits, etc. But I think it's not easy, especially when they have seen that if a large project, if they invest in, and that does not go the way they plan, there could be downsides and ramifications, and it's not easy. So that is, I think, something which is holding it back. I believe that this whole tariff thing is something which could be a threat which can be converted into an opportunity, because India's share in exports is actually very low, right? And if you see globally, any economy which has really become globally competitive and of certain size has always gone through, large exports. Whether it is Germany.
So we are at 11-12%.
Exactly. So we are at 12%, and that is what needs to grow. because that is what can get us to higher level of growth as well. From whatever 6% or so that we're growing, if we have to really grow at 8, 9, 10%, which is what say China did or Taiwan or all these Southeast Asian economies did. For us to be able to do that, I think we will have to identify our areas where we have right to win and then kind of really invest in that.
That's also at this point right now, sounds counterintuitive because there is a tariff war going on.
Correct.
And if you say, okay, I'm going to step up exports, but suddenly, let's say tariffs from the US go back from 10%, which is in any case has a 90-day expiry period, back to 26%.
Correct.
Then how does it work?
So yeah, so you're right. It's not easy for any corporate to invest in that to plan. But I mean, if I were to say that, okay, fine, I don't think it will be 26%. I think it's more of a...
Yeah, it looks like it's going to get negotiated down.
Down. But I think all the narrative that we're seeing, and if we see US, and if we kind of strategize keeping in mind what US wants, US certainly is seeing China as the threat, right, in a big way, because now that they have gone into high technology areas, AI and autonomous cars and all that. So that's what, I mean, that's my sense that they are the US thinks of China, and then in that case India can be in some ways a counter to that. And therefore there is I would say from a geopolitical perspective, India may have an opportunity. And there are segments wherein India could actually have a right to win. I mean, just to take example, say textiles. Now, textile is a very low-end kind of a thing, not technology intensive, but it provides employment, which has been a challenge for India. Now, if we are properly, and our exports on say ready-made garments just about $3 billion or so. If you compare, we are much lower than Bangladesh. Vietnam is some $40 billion, China is some $20-30 billion. So we are very, very small. Now, if we get even a 10% advantage on tariff, I think it can allow people to invest, scale up and then be competitive, because this thing also will not be there forever. The tariffs they are also fickle, but at least it gives opportunity to a businessman to, have some kind of a window of say 10%, 15% tariff protection. And then it can kind of build its own supply chains, into US and other markets.
So you mentioned electronics as one this thing. So when you see your portfolio, where are you seeing action in terms of, let's say, companies who want to raise debt, maybe coming back for fresh ratings or engaging with you, and really, I mean, that also perhaps tells us about where investment is happening.
So if you see, the biggest would be the infrastructure sector. That is really where the maximum debt is kind of happening, because each project requires them to borrow more. So, and within infra, it will be roads, while that is kind of maturing and plateauing a little bit, but still roads is a big thing. Second is renewable energy. These are the two big segments. And renewable, again, there is a clear focus of the government. We are going backward integration. We are reducing our dependence on China for solar cells and modules, etc. So that, I think, will continue to be the key focus area. So that is infra. Obviously,
when you say infra, you mean engineering and construction companies who are
EPC, not engineer. So yeah, I mean EPC companies.
EPC companies who are raising funds as working capital, or
no. So bulk of the debt which is going here is in the form of raising money, long-term project finance debt, which is to fund their project. So typically, the way it works is that you will have to raise debt and then you will kind of pay it back through either say some kind of an annuity from the government or your some tariff, which, so it's typically a 15 to 20 year kind of a debt, and generally through the bank financing, which is kind of, so that is one large segment.
Is it infra?
Infra, within infra, roads and renewables, also airports and ports, but those are smaller ones. The big ones would continue to remain as roads and renewables. Second, is the BFSI. Now, BFSI, again, banks obviously raise money through deposits. So that's not really, typically that's rating agencies don't come into play as much. But the NBFCs, when they for them, the key source of funding apart from bank financing is actually bonds. So they are the ones who issue bonds. And that's again is a key driver of the growth. So that's where we are seeing, while last 1 year or 1.5 years was low because RBI had taken some action, they wanted to cool it down and all that. But now we believe again going forward, there will be growth in the BFSI space. Manufacturing is actually where the debt is not, at an aggregate level, the debt is actually coming down, and that's what I mentioned to you, the leverage is reducing. So because there, they obviously on a year-on-year basis, they generate surplus cash, right? Whatever profit you have. And that, unless you start investing it in capacity enhancements, you really pare down your debt. So which is what is happening in many industries, while in some, say steel, etc., there is still some capex which is happening and, some debt is being taken up. But at an overall level, the debt increase is much less in the manufacturing. at an overall level. Again, coming back to electronics and textile, now those industries are actually not so much capital intensive. Within textiles also, if you see, ready-made garments is not, if you go backward integrated, into yarn and spinning, that's where, it's more. So if we increase the capacities there, then yes, that is where they could be.
So, I was talking to someone in the garment space, and they were saying that basically one of the risks that Indian garment manufacturers face in taking on big orders is the fear that those orders will not come back. And which is why they do not expand beyond a point, even if they could technically. I don't know whether this applies to other industries and how you see this.
No, I think that is again because we are a marginal player, and that is where this threat. If I were to compare within the textile only, if you see the home textiles, now that is a space where people are fairly confident, and India has a reasonably good market share. But especially in the ready-made garments is where we are a marginal player, and that is what our fear is, that this time I may have gotten order because some factory in Bangladesh or Vietnam was not working, and therefore the next year what is it? And that is where, as I said earlier, if we have a year or two of opportunity of whatever, or even a 10% arbitrage, that could really play out.
Right. So let's come to tariffs then.
Sure.
And this is obviously a very dynamic environment, and tariffs are going up and down. Things could get negotiated because some semblance of normalcy may return. But at this point, we don't know. So how are you looking at your universe of companies, particularly those who are affected by this?
Yeah. So if you see, India exports about $80 billion of exports to US, which is roughly about 2.2% of our GDP. Out of this $80 billion, 50 to 60% is accounted for by four industries, which is textiles, electronics, gems and jewelry, and
Oil.
No, not oil. Textiles, gems and jewelry. I always forget this. Pharma, obviously. Now, to take pharma,
We export oil, but not to the
yeah.
US,
So pharma is the one which is the safest, at least whatever we've heard from US till now, because they have kind of kept it out of this whole duty
Trump
structure.
did say he wants to
He
put
did
it.
say that's he keeps saying that, but I think our
But at this point,
our view is that pharma, it's very difficult for them to, because it will be clearly inflationary, and we are anyways the lowest cost producer, and that is why we actually, we all in generic space and all that. So if they were to increase it, I think largely it will get passed on, and therefore, he may not want the medicines to get more expensive. As it is, so if we are selling, and that's what, when we are having conversation with a pharma player, it is not that if I sell it at, say, 10 rupees, that thing gets sold at. What we sell at 10 rupees actually gets sold at 100 rupees.
Yeah.
So there is a whole huge distribution chain in a pharma distribution chain. That's kind of a monopoly business in US. So even if someone has to take that hit, it will be that chain, and I don't think there will be much impact. So pharma is that way relatively soon. The one which will be certainly impacted is gems and jewelry, largely diamonds. And that is because that's a non-discretionary item. So even if you were to say it's a 10% tariff, now diamonds, as it is, they're expensive, and we don't really add that much of value. We import diamonds,
Roughs and that,
right?
yeah.
We import roughs, and we then export. We maybe have, typically these companies would have 5-7% of margin. So I don't think they have any capability to absorb that extra 10%. So they will actually pass it on. And when they pass it on, ultimately the price of that product will become more expensive. And as such, there is anyways, discretionary. So I think the demand will kind of, certainly weaken. And therefore, for the Indian players, they will not have as much of revenue. So that is clearly a negative for us. The other are textiles and electronics, as we spoke earlier. So textile, I think, while it is a threat for us, because even if it is 10% or it is 26%, we are a marginal player. We may, miss out. We may not have those economies of scale, etc. But the question will be, where do we stand at a relative level vis-a-vis, say, because the original, if you remember, the tariffs on Vietnam were like 40-45%. Bangladesh was also 30%. And then China, though I don't know what's the latest, keeps on increasing.
145.
145, yeah. Today. So, yeah, so in that sense, there is an opportunity, as I said before, for India to make this threat into an opportunity. But then for that, we will have to invest. Either the government gives some kind of a incentive for people to cover your question, as you said, that people may not, what if 2 years later, Trump is not there, or 3 years later, whatever. So on that count, we will have to see. So textile, I think, is a positive for us because we also have a backward supply chain integration. We have enough spinning capacity in the country, and we have cotton as a crop as well. So that is there. Electronics, I think it will depend. Electronics has been a recent growth, largely because of, say, Apple kind of deciding to shift its manufacturing, part of its manufacturing to India. So if Now the question is whether they will take that manufacturing to US, because that they may also have that pressure. But if that doesn't happen, then I think we could see some shift on the same from China. But again, there the risk is that we're not backward integrated, and there that to get backward integrated, even China is not backward integrated.
Yeah.
China also gets it from Taiwan and Korea and all that. So at least we can be the last mile assembly kind of a thing, and again that will help us on employees, right, at the employment generation. So these two I would say are kind of opportunity, more of an opportunity, both in electronics and textiles. If we were to play it right, diamonds will be negative, pharma is right now neutral, so therefore positive.
Right. So, and then therefore you're saying that the overall impact of tariffs, worst case, even in the worst case situation is...
So now these are only 4 where we have a direct impact. Now the second order impact is where it gets more interesting, because if you see, say steel, right, and you may have noticed the government has, a 12% safeguard duty has been imposed. Now that is the indication of how the Indian domestic manufacturers could be impacted. Now if China or Vietnam is not able to export to US, practically they will look for other markets. So they will kind of dump in India, and therefore while steel is a more high profile and more lobbied kind of a industry, so therefore they could work out and get some protection, but it may not be there in other sectors. Now, chemicals is other one, where there could be, because these are all commodities. So there could be. So what I am more worried, say from our rated portfolio, is that when this kind of, if there was to be this kind of a dumping, that is how the Indian players could get, their margins could be impacted significantly. Because in all, if you see mostly all commodities, global supply, if you see 40 to 50% capacities and production is actually in China. So it's really a behemoth. So in that sense, they can really impact our overall domestic thing. So that is something, again, we are very mindful of, and we are seeing in which sector the government is providing protection or not. But it's kind of very, very iffy at this point of time.
Right. And sort of last question, we've begun a new financial year a little while ago. So how's the broad sort of top view outlook for India Inc. for the next quarter? So let me supplement that.
Sure.
Obviously, economy has been slowing down. There's a sense that we will recover or should show signs of recovery in the second quarter of this financial year. At least that's what some people say.
Right.
What's your own sense? And
so we also feel there will be a bit of slowdown. Last year, we have ended, our expectation is about 6.4%. This year, we're saying it will be a tad lower at about 6.2% or so. And that is again because while consumption is...
I think it's the same as the IMF figure.
I think so, yeah, similar to that, And the issue is that the investment, the private capex will not really happen. And the government also is, if you see the narrative has changed a bit, and they are now looking at more reducing the fiscal deficit, etc., which is a good thing. The government balance sheet should also be strong. So they are in their whole attempt at reducing. So the government capex may not grow as much. It may remain similar to what it was last year. So at a very high level, we are saying this is kind of a tad lower. Again, I would say at this stage, it's very difficult to guess, especially because of these tariffs, how it will play out, whether it will be a threat or it can become into an opportunity. I am keeping my fingers crossed, but I think I'm kind of neutral to positive that, what we discussed earlier, there will be some opportunities for India. Again, one thing very keenly we are watching out for is these trade deals, bilateral trade deals. Now, what could possibly happen is that ultimately at the end of it all, the whole world can get divided into 2 trading blocks, right? So there will be people who are aligned to US and people aligned to China. And if it really gets tense geopolitically, so then again, we will have to see how India is able to kind of maneuver that and really play it out. So that is something that we will...
But that's sort of tariff linked or external.
Correct.
But and what are the internal signals telling?
So internal, I think it will be more or less the same as last year. We're not seeing any significant difference.
Even in terms of corporate growth.
Exactly. I mean, so the growth even last year wasn't really much, right? If you see even the large corporates like Hindustan Lever, otherwise they've not really be growing much. So we expect something similar this year as well. But yes, I mean, as I said again, we only look at credit risk. But from a credit risk, we don't really have any reasons to worry yet.
That's a good note to end on. Sachin, thank you so much for joining me.
Thank you. My pleasure. Thank you.